I've spent more than 30 years in the financial services and investment industry with experience spanning from trading, investment management, advisory services, and alternative investments. Over the years, I've had opportunity to see markets from a number of different perspectives. And the one thing I've learned is that investing isn't simply about finding the next great investment. It's about understanding risk, managing risk, and knowing what can happen when you're wrong. And that's really became the foundation of how I approach investing today. What attracted me was the combination of economics, psychology, mathematics, and human behavior. Markets are constantly changing, and you can study the fundamentals, technicals, volatility, and interest rates and sentiment, and the market still could surprise you. The uncertainty fascinated me, and over time I became particularly interested in derivatives like options because they provide something that traditional investing doesn't always provide: the ability to define and manage risk in very specific ways. Theta Capital Management is an investment management firm behind our alternative investment strategy. The objective is to provide investors with access to professionally managed strategy focused on risk management, volatility, and market neutral investing. We aren't always trying to predict whether the market is going to go up or down every day. Instead, we're just looking for opportunities where we believe that the relationship between the price and volatility and time creates an attractive risk adjustment of opportunity. And that's just importantly when we're asking what happens if we're wrong. Because I believe investors tend to focus too much on the question, how much can I make? And not enough on how much can I lose. If you lose 10%, you need 11.1% gain just to get back what you lost, where you started. You lose 25%, you need 33%. You lose 50%, well, you gotta take back about 100% gain. So controlling drawdowns becomes extremely important if your objective is long-term compounding. My philosophy is simple. You don't have to eliminate risk, you just have to understand it, measure it, and manage it. My focus is primarily on what I would describe as market neutral, risk managed strategies. Rather than simply take a position and hoping the market moves in a specific direction that we expect, we can use options to construct positions designed around volatility, time decay, and defined risk parameters. But I want to emphasize something important. The strategy itself isn't the edge. The real question is how you select a trade, the size position, manage volatility, and control the downside. One of the things I've become passionate about is investor education. There's a lot of complicated financial concepts out there, and sometimes they're explained in such a way that it's difficult for the average investor to understand. Now, my goal is to take concepts like volatility, options, and portfolio risk, drawdowns, alpha, beta, and explain them in a straight word language. You don't have to be a professional trader to understand the principles behind risk management. Prediction is extremely difficult. I don't believe anyone constantly knows exactly which way the market's going tomorrow, or the day after, or the next week. Instead, I prefer to build a process around probabilities and risk. We can ask questions like, what is the implied volatility? What's the expected move? How much capital we are putting at risk? What happens if the market moves against us? And what happens if volatility suddenly increases? And what happens if we experience a much larger than expected move? I think one of the biggest misconceptions is that alternative investments are automatically more complicated and risky, and therefore sometimes better or worse. Complexity doesn't equal sophistication, and alternative investments should have clearly defined objectives, transparency strategy, and appropriate risk controls, and an investor who understands what they are investing in. Investors should ask questions like, what is your strategy, and where does the returns come from? What are the risks? What happens during the market crisis? What are the fees? What are the liquidity restrictions? And perhaps more importantly, what would cause me to lose money? Start with education. Don't start with the promise of return. Understand the investment first. Learn how the strategy works. understand the risk, understand the potential drawdowns, which is losses, and understand how the investment fits in your overall portfolio. That's really the purpose behind the educational content we're creating. Whether you're an experienced investor or someone just beginning to explore alternative investments, my goal is to make these concepts easier to understand. I probably summarize it in 3 words: understand, manage, and compound. Understand the investment, manage the risk, and give your capital the opportunity to compound over time. There will always be another trade, but capital that's lost is much harder to recover. So I believe successful investing isn't necessarily about taking the biggest risk. It's about taking intelligent, measurable risks and having a process for managing them, and that's the secret for every investment.